While investors have flocked to AI or space-related businesses, payments companies with far better unit economics have become unfashionable in the market, so their valuations have compressed and appear to be very attractive. What's fascinating about this moment in time is the sheer disconnect between the business reality and the stock market's perception. While these companies are processing record volumes and becoming more indispensable than ever, their valuations have been crushed, creating what might be one of the most compelling investment setups in recent memory.
Infinitely curious, we question what we see, seeking out the place for smart money to be. We don't have the answers, no crystal ball in hand, but ask the sharper questions to better understand. Markets keep on moving, infinitely curious. Markets keep on moving, moving, moving. Markets keep on moving, moving.
Hi, welcome back to the Rock and Turner Investment Podcast. We're excited to have you join us for another episode filled with valuable insights and expert analysis to help shape all of your investment decisions.
Before we begin, please note the following legal disclaimer. The views and opinions shared in this podcast are intended for entertainment purposes only. Any references to regions, countries, sectors, stocks, securities, or other assets are for discussion purposes and should not be considered as recommendations to buy, sell, or pursue any specific investment strategy. This content does not constitute accounting, legal, tax, or investment advice and should not be relied upon as such. The material may include forward-looking statements, forecasts, or projections, which are inherently uncertain and not guarantees of future results. There is no assurance that any predictions or projections will materialize. All data referenced in this podcast has been sourced by us and is provided without warranties of any kind. The data may contain errors and should be independently verified before use. Neither we nor the data providers accept liability for any reliance placed on the information presented. Always conduct your own research, seek professional advice, and take responsibility for your investment decisions.
We live in a world where the act of buying something has become almost thoughtless. You tap a card, you click a button on your phone, or an app automatically deducts a subscription fee, and the transaction is done. But beneath that simple surface lies what I like to call the invisible rails of global commerce, a complex, high-stakes web of technology that moves trillions of dollars across borders every single year. This is the payments industry, and right now it looks very interesting from an investment perspective. Allow me to explain. After the great financial crisis of 2008, we experienced a decade and a half of cheap and easy money. That caused asset bubbles everywhere, from real estate to equities. Yet today, we find ourselves in a different world. Nationalism trumps globalization. Rates are no longer zero. There are tariffs, supply chain shipping disruptions, an energy crisis, and geopolitical turmoil. All of these factors are driving inflation and causing input costs to rise. Yet payment companies are largely insulated from all of these headwinds. More particularly, they don't need branches, inventories, manufacturing plants, or large lending portfolios to grow. Plus, these are not businesses that can be disrupted by artificial intelligence, and that really matters. Last, but by no means least, while investors have flocked to AI or space-related businesses, payments companies with far better unit economics have become unfashionable in the market, so their valuations have compressed and appear to be very attractive. So let's explore some of the opportunities in this sector. We're going to peel back the curtain on this world by focusing on three companies that have built what are essentially high-tech toll booths on these rails: Adyen, Wise, and dLocal. What's fascinating about this moment in time is the sheer disconnect between the business reality and the stock market's perception. While these companies are processing record volumes and becoming more indispensable than ever, their valuations have been crushed, creating what might be one of the most compelling investment setups in recent memory. We are going to explore why Adyen is the undisputed king of payments, how Wise is weaponizing scale to disrupt the centuries-old banking system, and why dLocal is the essential bridge to the billions of consumers in the global south. Let's start with Adyen. If you've ever paid for a Netflix subscription, ordered an Uber, visited a McDonald's restaurant, transacted on eBay, or bought a latte at Starbucks, you've likely used Adyen without knowing it. Founded in 2006, Adyen was built on a very simple but profound observation. The global payments industry was a mess of fragmented legacy infrastructure. Most payment providers grew by buying up smaller companies and stitching their systems together, a Frankenstein approach that resulted in disconnected systems operating behind a single brand. Adyen took the opposite path, building a single, unified platform from scratch that combines a payment gateway, processing, risk management, and settlement all in one code base. This technical detail is actually their greatest competitive advantage because it gives them total visibility over every transaction. For a giant like McDonald's, this isn't just about processing a payment. It's about using payment terminals as data collection tools to understand customer behavior across thousands of locations. Because it's one system, Adyen can offer higher authorization rates while lowering payment fraud, which, for a massive enterprise, can be worth millions of euros in revenue. Right now, the market is obsessed with the idea that Adyen's growth is slowing. The company recently guided for 20 to 22% growth for 2026, and because that's lower than the 40% growth experienced during the pandemic lockdown era, some investors think the story is over. But Adyen is simply transitioning from hyper-growth to durable growth. They processed $1.39 trillion in 2025 alone. Think about that scale. They retain only 17 basis points on those transactions, which may appear to be a small fee, but on that volume, it translates into large numbers. This is a business that produces a 55% EBITDA margin and is on course to hit 65% soon. This is a business that generates massive profits while helping its customers grow. Adyen is also sitting on $3.8 billion in excess net cash. Now here's where it gets interesting. For years, Adyen was almost ideologically opposed to acquisitions, but in 2026, they've bought two companies. The first was Talon One, a loyalty and promotion software provider. The second was Orb, is an enterprise billing platform. This is a massive strategic shift, and it suggests that Adyen is evolving from a payment processor into a full-scale financial operating system. This market-leading compounding machine is valued at a price-earnings-to-growth ratio of only 0.7. It defies belief. Moving on to the next company on our list, if Adyen is the king of the merchant checkout, then Wise is the disruptor of the way money moves between individuals and businesses across borders. Wise started as a hack by two Estonians in London who were tired of losing 5% of their income to bank fees just to exchange currencies every month. They realized they didn't need to send money across borders at all. They could just swap currencies with each other. That hack has evolved into a global infrastructure business that processed nearly $200 billion in financial year 2025. The interesting part here is that Wise deploys a concept the Nick Sleep called scale economic shared. It's the same playbook used by Costco and Amazon. As Wise gets bigger and its costs per transaction go down, they don't just pocket the extra profit, they lower their prices for the customer. This creates a powerful flywheel where lower prices attract more volume, which lowers costs further, allowing for even lower prices. Not only does this enable the business to scale rapidly, but it makes it increasingly difficult for a newcomer to disrupt their business. It's a deep and wide moat. The traditional banking system relies on the SWIFT network, a 1970s messaging system that is slow, opaque, and expensive. It requires a chain of intermediary banks to move funds. The average cost for a digital remittance through a bank is still around 6.5%. Wise's average take rate? Half of 1%. That's more than a 12-fold cost advantage. Wise has spent a decade securing over 80 licenses and direct connections to local payment rails like Faster Payments in the UK, Pix in Brazil, and UPI in India. Banks like HSBC have tried to build competitors like Zing, but they failed because they can't compete with Wise's economics without cannibalizing 80% of their own profits. It is a classic case of counter-positioning on the part of Wise. In fact, they've even turned potential competitors into customers through Wise platform, where banks like Morgan Stanley and Standard Chartered actually use Wise's payment rails because they are better than their own. The stock has been hit recently by news of a money laundering investigation in Belgium, but there have been no formal allegations against the company. Meanwhile, the business is growing at 35% annually and is valued at a PEG ratio of just 0.5. When you find a high-quality compounder like this trading at a discount because of regulatory noise, as Warren Buffett says, you should back up the truck. Now let's move on to the third company on our list. Here we have to talk about the hardest part of the map, the emerging markets. If you are a global giant like Amazon, Nike, or Disney, and you want to sell in Brazil, Nigeria, or Indonesia, you face a nightmare. These countries didn't adopt the credit card culture of the West. They skipped straight to mobile wallets and instant bank transfers. In Brazil, 70% of the population uses Pix. In India, people use UPI. dLocal was founded to solve this problem, and it has become a toll booth business in these markets. It integrates over 600 local payment methods into a single API, what they call one dLocal. They handle the pay-in from the consumer and the payout to local vendors or drivers. Their moat is local density. They hold 38 regulatory licenses across more than 60 countries. While a competitor like Stripe is great for cards in the United States, they don't have the depth to handle a cash payment in a Nigerian convenience store or a Pix transfer in a Brazilian favela. The numbers for dLocal are staggering. Their total payment volume grew 73% year over year in the first quarter of 2026. However, the stock has crashed from its 70 peak to the mid-teens. Why? Part of it was due to an overvalued IPO, which needed to work its way out of the price, but it is also because their margins compressed recently. But here's the thing that the market missed. dLocal is onboarding Tier 0 clients, the absolute biggest companies on earth like Amazon and Microsoft, and these giants have massive negotiating power to lower their rates. dLocal is trading margin percentage points for massive volume scale. Once they are the engine for Amazon's payments across 60 emerging markets, they are incredibly hard to displace. They are also moving into new products like BNPL Fuse to solve the problem lack of availability of credit in emerging markets, and to stablecoin settlement rails to manage the issue of trapped cash in countries with currency controls. With a return on invested capital of 68%, this is an incredibly high-quality machine that the market is treating like a broken business. dLocal is priced at a forward PE of 17 times despite 70% volume growth. This brings us to a compelling theory. These three companies are no longer just operating in parallel, they are moving toward each other. There is significant speculation that Adyen might use its cash pile to buy Wise or dLocal. The logic is undeniable. Adyen has the enterprise relationships in mature economies, Wise has the best cross-border FX rails in the world, and dLocal has the local density in rapidly growing emerging economies. If you put them together, you've created an unbeatable global financial operating system. It's worth noting that Adyen's CEO already sits on the board of Wise, so there are already connections between these businesses. Then there's the next frontier, agentic commerce. We are moving toward a world where AI agents, not humans, will be searching, negotiating, and paying for things autonomously. This transition will be chaotic and fragmented, with competing protocols from Google, Visa, and OpenAI. Adyen is positioning itself as the universal translator for these agents, acting as the infrastructure layer that sits underneath all of them. To wrap this up, the payment sector is currently in a state of valuation reset. The pandemic-era euphoria is gone, and the momentum-chasing investors have moved on to the next shiny thing. What's left behind are high-quality, cash-generative businesses that are processing trillions of dollars with massive competitive moats. These are companies that pay no dividends because they are investing in growth. All are immensely scalable and growing at rates that were only seen in the software sector. The toll for moving money is getting cheaper for merchants and consumers, which is a good thing for the world. But as more global commerce digitizes, the amount of traffic passing through these toll booths is set to explode. For the patient investor who can look past the next quarter's headlines, these toll booths are all in a very good position to win big. If you want to explore any of these companies in greater detail, you'll find deep dive investment analysis on each at rockandturner.substack.com.
We really hope that you enjoyed today's podcast, but we really only scratched the surface. If you want to explore any of the themes discussed in more detail, see the show notes or visit us at rockandturner.substack.com. Oh, one more thing. Be sure to like the episode, share it with others, and save it to your favorites so that you don't miss future episodes. Until next time, we wish you every success with your investments.